Welcome back to TradeSmart. This is the release and tutorial video for our latest premium TradingView script, which is a divergence trading strategy script. With this script, you can trade regular and hidden divergences using multiple indicators like the MACD, RSI, wave trend, and so on. Also, this premium script, just like the other ones, have all of our developed filters and limiters which can easily make your strategies way more profitable and robust. In this video, I will also share two optimizations using the script, one for regular divergences and one for hidden divergences. If you want to try this new script and all of our other premium scripts, become a Smart Trader tier member on our Patreon. Of course, trading divergences without this script is absolutely possible, so it's not necessary for you to pay anything for them. But with our premium divergence script, you can make optimization, backtesting, and trading 100 times easier. You can backtest how a divergence strategy would have performed in recent years with just a click of a button. And you can make divergence trading 100% objective and rules-based. You can also use our trading scripts as a trading bot. With that out of the way, let's get right into it. I will assume that you already know what a regular and a hidden divergence is, so I won't explain it now. However, if you don't know, just do a quick Google or YouTube search. It literally takes 5 minutes to fully understand them. This script follows the same structure as our other scripts, so on the top we placed the base logic settings of the strategy. Under that you can find the position and trade management setups, and after that all the filters and limiters. In this video I will only go over the base logic settings, as recently I made a 1 hour long detailed private tutorial video for our premium scripts. I will leave a link to that video in the description. The first setting is the pivot period. Pivot points at divergences are the two high or low points. For example, here you can see a regular bearish divergence. And in this divergence, this is its first and this is its second pivot point. With the pivot period, you can set the minimum distance in candles needed between the 2 points. So if you don't want to allow small divergences, then set the pivot period to, for example, 20 or 50. This way, any divergence that has less candles between their 2 pivot points than the value you set here will be discarded and won't be traded. After that, we have the source for pivot points, which is self-explanatory. If you want to use the closing price of the candles as pivot points, then set close. But if you want to use high-lows as pivot points, set high-low. Next up, you can set the type of divergences you want to trade. You can choose regular or hidden or both. I recommend you don't use both, as these are two different types of divergences and should be optimized separately. For example, I would use a trend filtering moving average for hidden divergences, but wouldn't for regular ones. At the next field, you can set which indicator you want to use as your divergence indicator. The most common ones are MACD and RSI, but you can choose from 13 different indicators. And here I have to mention a very important aspect of this script. Spotting divergences is easy with these indicators, but where we should enter into a position is a whole different thing. For two-line indicators, like the MACD or wave trend, we decided to make the script enter into a position after the divergence is spotted and the next cross down or cross up happens. For example, here is a bearish divergence spotted using the MACD, and when the MACD crosses down, the strategy will enter into a short position. But what will trigger the position entry if we use a one-line indicator? Here is an example. As you can see, the strategy spotted a bullish divergence using the RSI right here. What we decided to do in case of one-line indicators is to add a moving average on the used indicator, making it a two-line indicator. Then entry points becomes very simple. The strategy will enter into a position when the indicator crosses above or below the moving average. And as you can see, that's exactly what happens right here. The RSI crossed above the moving average, triggering a long position entry. You can set the use moving average type, length, right under the divergence indicator settings. If the use divergence indicator is a two-line indicator, the strategy simply won't use this extra moving average for entries. Under this group of settings, you can find a bigger group where you can set the divergence indicator's properties. For example, if you set the script to use MACD for divergences, just find the MACD settings in this group and you can modify the parameters of the MACD indicator easily. In the next few sections, you can find a few more advanced filters we designed specifically for this script. The first two is the chart divergence and the indicator divergence intensity. These two filters make possible to limit divergences based on their intensity. For example, here you can see two regular bearish divergences next to each other. But as you can see, they are not exactly the same. The first one has a much bigger slope or difference between its two pivot points. With the limit based on chart divergence intensity, you can limit what is the minimum and maximum difference that needs to be between the two pivot points. The calculation is a bit difficult to understand, so bear with me. First, you have to choose a divergence that has a slope you like. Let's say I want to trade divergences with a similar slope or intensity like this one has. To do that, first we need to add an ATR to the chart. Then I would recommend to increase the ATR length value to something higher, for example 50. This way we get a smoother ATR line. Once your ATR is all set, check the ATR value given on the first pivot point. The next step is to measure the difference between the two pivot points. For that, use the date and range measure tool. After you have measured, the value which you see here will be the price difference between the two pivot points. Now we just have to divide the price difference with the ATR value given on the first pivot point and finally multiply it by 100. This calculation will give us the ATR percentage divergence intensity specific for this divergence. So if we want to only allow divergences that have a similar intensity, just add a slightly lower value as the minimum chart divergence intensity and a slightly higher value for the maximum chart divergence intensity. Also, make sure that the ATR is set up correctly at this section. If everything is set correctly, just tick the box next to this section and the divergences will be filtered. The limit based on indicator divergence intensity works just like the chart divergence intensity limiter, so I won't go into details. The only difference you need to know is that this limiter is based on the indicator used for divergence. Therefore, instead of measuring the price difference on the chart between the pivot points, you have to measure the difference on the indicator. On two-line indicators like the MACD, you have to measure the faster moving lines differences. This way you can limit what slope or intensity you want to see on the indicator for a valid divergence. The reason we use the ATR percentage type calculations instead of only price percentage based ones is because ATR adapts to the current volatility, therefore you can create optimizations that work on multiple time frames and assets. Using price percentage based calculations wouldn't let you do that. Moving on, the following limiter is the divergence length limiter. This is almost the same as the pivot period setting, but here you can give not only a minimum but a maximum value also. Calculations are based on the two pivot points. So let's say I want to only allow divergences that have similar length to this one. To do that, I just have to measure the candle difference between the two pivot points. Once you got that, add a slightly lower value to the minimum length and a slightly higher to the maximum length. Then tick the box to activate it. And now the divergences are filtered according to this set length. The next filter we made for this script is the limit based on divergence pullback. Here you can choose from two types, distance percentage and ATR percentage. First, let's see the distance percentage as that's easier to set up. Let's say I only want to allow divergences that has a similar pullback to this one. To do that, I just have to measure the percentage difference between the first pivot point and the lowest point of the divergence, as this is a bearish divergence. Of course, if you have a bullish divergence, you have to measure the first pivot point and the highest point of the price. Once I got that value, I go back to the script settings and add a slightly lower percentage value to the minimum value field and a slightly higher one to the maximum value field. Then make sure the calculation type is set to distance percentage and tick the box next to this section. Simple as that. Now let's see how the ATR based type works. For the ATR based pullback option, first we will need to use the ATR indicator again and find the ATR value for the first pivot point. Then we have to measure the distance between the first pivot point and the lowest point. After that, you have to divide the value you get here, which is the price difference, with the ATR value at the first pivot point, and finally multiply that by 100. This will be the ATR percentage pullback for this divergence. Now go back to the script settings, and if we want to allow divergences with similar pullback values, just give a slightly lower value for the minimum value, then the ATR percentage, and of course a slightly higher one for the maximum value. Make sure that the ATR is set correctly and tick the box next to it to activate it. And the divergences should be filtered. And we reach the last option. What this does is that it can limit of how many candles can pass after a valid divergence has been spotted. The reason why we added this function is that it can happen occasionally that a divergence is spotted but the cross down or cross up on the indicator won't happen for an extended period of time. And in those cases, it might be a good idea to avoid taking entries. So to use it, type in how many candles you allow to pass after a valid divergence has been spotted and still enter into a position. Then tick the box next to it and you are all set. And with that, we went over the base logic of this strategy. After this section, as I mentioned earlier, there is the trade management and position sizing setups, where you can set dynamic order sizing, dollar cost averaging, trailing stop losses, multi-level exiting, and so on. Under this group, you can find filters like momentum, trend, volume, volatility, sessions, and many more. Now I won't explain how these options work, as it would take more than an hour, but if you are seriously interested in algorithmic or systematic trading, I will leave a link for that full tutorial video down in the description. And now let's see the two optimizations. Both of these optimizations has freeze and slippage included. The first optimization was made for regular divergences only, and it was made on the Bitcoin versus US dollar 30-minute chart. This optimization uses a trailing stop loss with partial exiting and a simple RSI limiter. As you can see, this strategy optimization was backtested between 2017 and 2022. The strategy took 677 trades and made 151% net profit. Profit factor is 1.47 and the max drawdown is 13.2%. You might think that the net profit is relatively low, considering it took years to achieve, but as I said in other videos, we are not focused on outperforming any buy and hold returns using only one optimization. What we are focused on is to create many strategy scripts and many optimizations which are robust and delivers profits steadily in a bull and a bear market also. Once we got dozens or hundreds of these robust optimizations and strategies, we can run all of them simultaneously as trading bots. These trading bots will most likely outperform any buy and hold returns. Now let's see the other optimization. This one is also made for Bitcoin versus US dollar, but now I used only hidden divergences on a higher 1 hour time frame. I also optimized this strategy on bigger time interval. As you can see, the starting date for this optimization is 2011 and the end date is 2022. This strategy also uses trailing stop loss and partial exiting, but I added a move stop loss to break-even function and the trend filter also. This optimization made 555 trades, had 123% net profit and only 11% max drawdown. The profit factor is also quite good, 1.57. If you are a Smart Trader tier member, you can find both of these optimizations in our Discord chat. If you are interested in our other script release videos, check out this playlist. And that wraps up today's video. As always, thank you all for watching. If you like this video, don't forget to drop a like, subscribe and turn on the notification bell so you won't miss any of my upcoming videos. As always, thank you all for watching, have an amazing day and see you in the next video.